All right, everybody, it's a couple minutes past the hour. Thank you, everyone, for joining. A couple notes before we get started. My name is Matt, and I'm one of the brokerage managers here at Penny Insurance. As we go through this presentation, if anyone has any questions that they need answered or any comments, please write them in the chat. I do have Chris here, who's also from Penny, to help answer those and to prompt me to ask those questions as they come up. So this is another one in our series of educational webinars that we're doing for agents to just help expand knowledge out there about different insurance topics. And today specifically, we're going to be talking about survivorships and really just how to unlock the power of survivorships, what they're used for, kind of some business case studies for them, and then also some tips and tricks to kind of position them with clients, type of clients to look for, and ultimately who does this product best suited for. Before we start, just gotta pitch a little bit about Penny for any of you that are not familiar with us. We're a independent IMO that is based out of California, although myself, I am in Oklahoma. A couple of other brokerage managers are across the U.S. And we service the full country, so we're a national IMO. Over 50 years of supporting people. We really focus on providing innovation, service, and results, and try to be very nimble as the markets ever change to be able to stay in front of trends and be able to help our agents and agencies really succeed in changing times. With that in mind, and with the focus on survivorship today, I wanted to introduce Mike Woods, who is not unfortunately on the call, but I did want to give him a shout out. He's actually an in-house underwriter for us, something that Penny has that not a lot of other BGA/IMOs have. So why is that important? Well, with large cases such as survivorship, when you're normally talking more complex, bigger premium, a lot more moving parts, you really want to get the underwriting down, place it in front of a carrier that you can get the first app in and completed, know kind of what ratings you have, and that's where Mike comes in. He's our in-house underwriter with over 35 years of experience in the industry. He has a relationship with all the major home office underwriting teams, including their leaderships. He routinely gets on calls, on panels, asked to come out to the carriers to really give input and learn about where they are, what they're doing, really in depth with what they're doing for underwriting. So that way, when cases do come in, he knows, what those underwriting teams are going to think in regards to a particular case to make sure that we can best position it for the carriers. He's a member of the Libra Underwriting Committee, and he's an accomplished chef. I mean, the guy, I've been told, has some amazing food. I unfortunately do not live in California, so have not had the chance to partake yet, but that is one of the first things when I go out to visit that I am going to be doing. So now for survivorships. We're going to cover kind of 4 key areas: estate preservation, business succession, charitable giving, and special needs planning. I'm going to cover them in reverse order, as I feel like as we go up the list to estate preservation, that's going to be the one that you're most likely going to have a lot more clients looking into. So I just want to cover these other aspects first. But we're going to meet the Johnsons. This is going to be our sample couple that we're going to take through this whole journey. Kevin, age 60, good health and a lawyer. Sandra, age 60, good health and accountant. So your average, family in their, 50s to 65 is where we see a lot of these cases starting to be placed, because that's when people are starting to think about legacy, taxation, and everything that kind of comes along with, putting a survivorship together. So for special needs planning, we're going to say that they have Zach. He's 35. He's independent. He's loved nature. He's a cashier. So he's able to sustain himself independently, but they still want to make sure that he is well taken care of. So they're going to use a survivorship to fund a special needs trust. That's going to allow for assets to be used as you intend. So the family is able to set up the trust, allocate the resources, kind of put the guardrails in place to make sure that Zach is going to be taken care of for his entire lifetime, once his parents, the caregivers, have passed. With it going into a special needs trust, it's going to help Zach qualify for other benefits. Since the trust is going to own the assets as well as the proceeds from the life insurance, those are not things that Zach himself owns. So that helps him qualify for Medicare, Medicaid, anything else, any other type of assistance program that he may need because the assets are being held in the trust. And it's going to provide the parents planning for Zach peace of mind that he will be taken care of. They're not going to have to worry about the money not being there when he grows older, not having enough money for buying houses, attending any schooling he wants, being able to provide for the basic necessities. Establishing that trust is going to give them that peace of mind, and having it in a survivorship allows them to plan it in a way that, once they pass, that trust is set up. I will note that I'm going to be covering a lot of these topics at a higher level. And the reason for that is when you start talking about the needs for a special needs trust, of course, we're going to need to have attorneys and stuff involved. We're not going to cover all the nitty-gritty details. These are more talking about the main aspects of what type of client is going to need for this, and then how to kind of position it so that way that this is something that they're going to want to pursue. The next thing we're going to cover is charitable giving. It's going to allow for the charity to be the beneficiary of the policy, which can provide a larger benefit than regular contributions. If someone really wants to fund a charity, whether that's giving the charity itself the death benefit, or providing a funding of a trust or other grant or fund to then continue to help support the charity, you're going to have a lot more leverage on your dollar by paying a premium of a survivorship policy and then allowing that death benefit to go to the charity. It does kind of push out your charitable giving a little bit since it is relying on you passing to pay that benefit. But for most people that are looking at this, they're looking to add that extra bit of oomph on top of the charitable giving that they're already currently doing, on a year-to-year basis. As I said, it can be used to fund a trust. And there is possible estate tax deductions for this. So the proceeds that are going to the charity can be taken out of the estate. This is something, once again, you're going to want to consult a tax professional on. But just note that the giving that they are putting in does have some tax implications for them and their heirs when the death benefit is paid. So now kind of into the two areas that I think that you'll find a lot more clients looking at survivorships and really kind of digging into what they need and kind of fitting that goal. And the first is going to be business succession. It's going to be able to help you facilitate a buy-sell agreement. So really giving the business owners a peace of mind that when they pass, that the business that they have, that the heirs will be able to be compensated without the business needing to be liquidated to do so. And that's really a key point with a lot of these succession plans, as well as estate preservation, is going to be the need to not have to liquidate in order to fulfill these types of goals. It's also going to help in estate equalization. So let's say Kevin and Sandra have two children, one that wants to continue in the business and one that doesn't. A survivorship will allow for that equalization of the estate so that one can get the business and the value of the business while the other is paid that death benefit. So that way both are treated fairly and equitably without the need of having to liquidate that business in order to pay both an equal share. So what does that look like in a little more detail? So Kevin and Sandra jointly own 50% in a law practice, Johnson & Smith, with a Tony Smith. Upon Kevin passing, his ownership stake passes fully to Sandra. So on upon Sandra's passing, Tony is paid the death benefit of the survivorship, and he uses that proceeds to buy out the 50% shares from Kevin and Sandra's children, Mark and Susan. So this kind of shows that example of using those proceeds as part of that buy-sell in order to compensate that next generation for the equity in the business that they are not taking part of. And the reason why survivorship works in this case versus other types of buy-sell is that Kevin and Sandra are joint owners of that 50%. So upon the passing of one, it doesn't negate the ability of the other to have that full stake in their half. And it really is upon that second passing that really there's a need for that buyout from their heirs. So we're going to start that estate equalization that we had talked about previously. So Kevin and Sandra now jointly own Johnson Financial Services. Apparently they have a lot of businesses that they own. So upon Kevin and Sandra passing, the business is given to Susan. The proceeds from the death benefit go to Mark to equalize the estate. And really what that means is that the Johnson Financial Services can stay as a full entity with each child getting a proportionate portion so that they're both treated equitably. If Johnson Financial Services has a valuation of $10 million, Susan's inheriting a $10 million business. Mark isn't getting anything because he's not part of the business. He'll get that death benefit to help equalize out the fact that he's not getting any stake in that business. This is just one of the many ways that a survivorship can be used. And it's one of the ways that you'll find that a lot of people, especially with businesses, have a need for survivorship outside of estate preservation. It's really the fact that you're trying to divide an indivisible asset, especially where someone may not want to take ownership of the particular asset, in this case, the business, from the other. You know, Mark doesn't want to work for the business or have ownership, so he's getting his buyout as part of the survivorship plan.